Here we go.
Money, money, making crap for money, money, and money, money.
So,
Money.
as I said, today is going to be all about credit. This is episode 3. This is what's it called? Episode 3 with the 100 days in finance. Inside the Vault edition, we're going to be with Jonas. Jonas has had a wealth of experience, and from everything you guys have said, it's about time that everybody now knows about credit. We're going to decode credit. We're going to demystify everything. So, right off the bat, you already know too much energy, too much energy. Let's go. So, in decoding credit, demystifying everything about credit, let's start with the first thing. What is credit? If somebody wanted to find out what is credit, how can you define what credit is exactly?
Okay, so in simple terms, credit really speaks to the type of lending products that banks or retail stores give. Simply means it is debt that you would make, and it is debt that is legal, and it is debt that is allowed, and it is debt that empowers you as a person to be able to do certain things by virtue of being lent money by a bank. And yeah, that's simply how I could explain credit. So in simple terms, credit products starts from having a loan. Credit product could be a credit card. Credit product could be a home loan. Credit product could be buying a car. Credit product could also be what we call an overdraft. So from your own personal account, then the bank can just attach a limit so that you are able to do certain things, and this credit product depends on short-term and long-term. So short-term, it's like your overdraft. So at times you find yourself probably saying, I just need 5,000 rand for 20 days. At the month end, when I get my salary, I want to pay the whole amount, and then the bank will charge you a certain portion of interest rate based on the days that you were using the product. And then there's longer term type of products where you would then extend your debt up to a year or 5, depending on whatever longer term you require or you need.
So, why do some applicants of, let's say, loan credit approvals get the credit approvals faster, and why do some get credit approvals slower? So, what is the basis behind that? Yeah.
Okay, so the reason why people get instant approvals, there's a few reasons. One is if the person that is applying or the applicant has a very strong credit profile. So when we speak about credit profile, we speak about credit score. So every time that you have a credit product, there is a certain scoring that you are given. And each time that you borrow, and as soon as you have a certain portion or limit that you are given, then the credit profile is there to show your behavior, how you are paying your debt back, how you are paying your credit back. That's the first one. Secondly, your income and your identity, if they are easily verified, you will get instant approvals. So income in a sense that when we confirm your employment, your employer is able to confirm that you are working there, and that salary that is showing on your payslip, that is your salary, and it can also be confirmed, and it can also be confirmed based on your bank statement as well. That's how then you are able to be given instant approval. So the risk score also falls within predefined approval threshold. So depending on the bank, depending on the product, some will tell you if your score is above 700 or from 680 points, automatically you qualify for better products. Anything less than 680, you are regarded as average, and average then means there's a high possibility that you will get higher higher interest rates and lower credit, as an instance. Yeah.
So you said that this actually goes even to the second question. So you said there's what's it called, credit worthiness score. Like there's usually a score that people usually put. Can you explain exactly how that score works? Let's say you said, like, let's say a credit approval of about 680. How do banks, like, what's the system behind now you being given that score? Is there like the name for that system? Is it AI based, or is it like
Yeah, so basically, globally, the most recognized scoring system is called FICO, FICO, and the full name is called Fair Isaac Corporation. So this FICO, Fair Isaac Corporation. So this FICO system is the system that is then used mostly, firstly, to determine your payment history. So your payment history is very, very important. Your payment history is very, very important. So how does this then credit? How does it work? So your payment history, for example, as you pay on a monthly basis and you pay your accounts, you pay your credit, your payment history is stored there. So remember, your payment history can go up to 12 months, 3 years, depending on the type of product you have requested, right? And this payment history will determine if you are a slow payer or if you are somebody who pays their accounts on time. So if you decide that, or you make an arrangement with the bank to say, I'm getting paid on the 15th, I want all my debit orders to go through on the 15th, make sure on the 15th you have money. Because if there are debit orders that are returned, that could count against you from a payment history perspective. Some people, what do they do when the salary goes into their accounts? So some give the bank, they get paid on the 15th, they give the bank a different date, like the 20th or the 25th. When they get paid on the 15th, then they go and draw all their money. By the time debit orders go to the bank, there's no money. That type of payment history counts against you.
Right. Can that be classified like as fraud? Or
in essence, yes, it is. Yes, you can, because in essence, you are defrauding the bank, and in the process, you are defrauding yourself. And in defrauding yourself, you are disadvantaging yourself for future. You are disadvantaging yourself for future credit, right? And then there's also what we call credit utilization ratio, right? Credit utilization ratio. So let's say you have a credit card for 10,000 Rand, right? Credit utilization ratio says you must only use your debt up to 30%. So what does that mean? If you have a credit card for 10,000, they only want you to utilize up to 3,000. And then 7,000 rent must be money that is always there, you know, for those rainy days, for when you really, really need money. So if you have a credit card for 10,000, don't go and blow the whole limit of 10,000. That will count against you because they're going to check your credit utilization ratio, and then they are going to check your debt exposure to say you borrowed 10,000, you owe 10,000. So chances are there might be difficulties for you to pay in the future if you are required to pay, you know. And the third thing,
okay. Third thing.
Yeah, so I was saying the third thing that is also critical and important, the length of your credit history. So your payment history goes hand in hand with the length of credit history. So length of credit history works in a way that banks can go as far as 24 months, 36 months, some up to 5 years, depending on the product you want. So let's say you want to buy a house. Usually to buy a house, it's 20 years, right? So they can go up to 5 years and say, oh, Jung, the past 3 years, he hasn't been a good person. His behavior started changing for the past 2 years, but the 3 years he was struggling. So then that's how they will determine the amount that they will give you. They will also determine your interest rate, you know, based on the 5-year performance or behavior that you were giving.
So I think you've answered even the third question. The third question I was going to ask about credit. How do banks really assess credit worthiness? So I think it's going to borderline on like the fourth question, which is usually which is actually a practical question. Mm-hmm. How do you increase your credit worthiness so that you can get a better score and get a better loan? Like let's say a high amount with low interest. I think that's the basis here. How do you increase your credit worthiness to a level where you can get a good credit score and a high loan amount with low interest?
So how do you increase your credit worthiness, right?
Yeah, one from the perspective of a common person, and then now two from the perspective of, let's say, an entrepreneur. Yeah.
Okay. All right. So from a perspective of an individual client or a customer, remember, based on what I said regarding credit history and so forth, it is important that at any given point, you must pay your accounts on time. Very, very, very important. And you must pay your accounts on time consistently. Don't pay your accounts for the 11 months and then in December you decide to go to Zanzibar and use all your funds to go to Zanzibar, pay your flights, and then you say, no, I'll see my account in January. That will count against you. So consistently, pay your accounts on time. That is very, very important to consider from a credit perspective. I've already spoken about credit utilization ratio. So make sure that you are always below 30%. You have a credit card of 10,000. Make sure you can only utilize your limit up to 3,000 rand, not more than that, right? Okay. Another thing that counts against people, and that is very, very critical and important to improve your credit worthiness, is avoiding a lot of credit inquiries. So how do you avoid a lot of credit inquiries? Some people are multi-banked. So they bank with NetBank. They also bank with NSBC. They also bank with Standard Bank. Now, because they want 100,000, instead of going to Nedbank, they go to all three banks at the same time and say, hi, I want 100,000. And obviously, some are doing this because they want to check what kind of interest rate will they be charged, what installment will they be paying or repaying. And based on this, all these three banks go ahead and they make inquiries on your profile. So depending on whether you start at which bank, let's say you start at Nedbank at 9, then you go to, and then when they say to you, okay, this is what you qualify for and these are the interest rates, you say, I have 5 days to go and think about it. You are the only person knowing that you are going to the next bank and so forth. So by the time you get to bank 2, bank 2 can now go into credit. They can see, oh, this one was at Nedbank. Already today there was an inquiry that was made. By the time you get to bank 3 can see, oh, this one went to Nedbank and then went to Standard Bank. Now NSBC then based on that would say, for the duration for this week or for this month, you already have 3 inquiries. By the time that you get to them, they're going to give you probably a lower offer, higher interest rate, and that already counts against you from a perspective of having a high number of inquiries, And remember, by virtue of the type of system that banks use, this information is not hidden. It's there. Everybody can access it, Like, for example, in our country, we have 2 main information systems where this credit scoring is stored. So we have what we call Experian system, and we also have TransUnion. So these 2 are the main that are used specifically to check your behavior and to check your history. So it's very, very important to limit your inquiries at any given point. So what does this mean? Only do inquiries when you know you definitely do need money. Don't do inquiries for the sake of saying, no, I just want to check if I qualify or not.
I just want to check if I qualify. So now that's from the perspective of now an individual. Let's say for like
for entrepreneurs.
Entrepreneur, yeah.
Okay. So for entrepreneurs, you need to separate your business finances and your personal finances. A lot of entrepreneurs are struggling with this. So how does this happen? You find that an entrepreneur has a business account, right? Some operate even as sole proprietors, right? So sole proprietors means I operate as Jonas Adoro or Roda Business Consultant, but my account is in my name. It's not in the business name. Some operate in a business, then the name of the business account is Oroda Business Consultants. These are 2 different people, but these 2 different people, this one operating as a sole proprietor and this one operating as a business, both of them must make sure that they separate themselves from their business. So they must make sure that they pay themselves a salary on a monthly basis. See? So meaning you can't go and swipe a business card or a business bank account for your personal groceries at home, because these are what other people are doing. And when they go to the bank to ask for credit, then we ask them, every 2 weeks you are buying things at ShopRite, every 2 weeks you are buying things at Woolworths. What is this that you are buying? No, I'm buying my personal groceries. Your personal groceries must go to a personal account. Separate your business from your personal finances. Number 2, it's very, very important to maintain clean financial statements as a business. Your financial statements shouldn't have things that are...
But
Yeah. You were
It
saying,
wasn't clear. It wasn't clear.
was
The last
it,
part.
was, okay. So I'm saying, make sure that you maintain a clean financial statement. Some businesses, what they do on their financial statements, when you want to assess whether they can afford the credit or not, you find that there are sinister transactions that are questionable. That will make the bank to decide, you know what, we are not interested in doing business with you, because you are not able to explain certain transactions on your financial statements. I know accountants tend to cook the books to try and assist these people to get funds. But
Yeah.
banks go as, if banks really want to give you credit, they at times they go as far as saying, okay, you are the director of this business, give us also your personal statement, give us also your business statement, and then they want to assess to see how responsible are you with money. And people tend to say, no, but I'm not the business, why do you want to assess me? We will definitely want to assess you, because at the end of the day, as the director, you are the same person who's going to run the business. You are the same person who's going to use our money in your business. So let's check if you are a responsible person, you know. And if they realize that you don't have your personal account, you are you are saying you are buying groceries, you are swiping everything from the business, but your financial statement is not even showing your personal salary, that on its own is going to be a challenge. So it's very, very
Oh,
critical to separate the two. And another thing that is important, you must demonstrate consistent revenue growth, right? And this thing of speaking about your revenue growth, people tend to do so. Let's say, for example, I have a business and I sell stuff. I sell maybe bottles or I sell potatoes. People tend to use transfers for people, to use a device to pay, like a transfer into their business account directly. And some also use cash. So you find that a person has deposits that are done through transfers and through um, and through payments that happen, by tapping their cards. And by virtue that when they sell potatoes, some people buy cash, then they decide to not take that money to the bank. So this then shows the bank, if you don't deposit your money, if you say, for example, no, every month I make about 200,000, but your statements can only show 150, we will not include the other 50,000 rent cash, because you didn't show it to us, you know.
imagine that.
So some people are not very disciplined. I remember there was a lady that I was mentoring who is selling chickens and eggs. But by virtue that at times people buy cash, she doesn't take this money to the bank. And when we looked at everything that she does, and also based on the financial statements, her revenue was around 40,000. But according to her, she was operating around 200,000 in revenue, because she was taking the difference as cash,
Yes,
using it
cash.
for other things. So when you go to the bank to try to apply for products, then you are told, unfortunately, you do not qualify, because what you are bringing into the business is way much less than the debt that you want to incur by coming to the bank. So it's very, very important to make sure that if your business is operating um, on this metrics of people paying you um, via your account payments, or they are paying you, tapping their cards, you have um, a device that customers can use. Make sure that even if there are at any given point, you is very, very, very important. All right. And then another thing that is important. Okay, so let me do this. I think this is where my challenge is happening. Can you hear me now?
Yeah, I can hear you.
Yeah. So I think this laptop tends to connect to the Wi-Fi, so that's why this keeps happening. So another important thing, make sure that at any given point you are able to show predictable cash flow. You know, cash flow is important to the business. Make sure you are able to prove that your predictions will be like that. And obviously, as I've already mentioned, this then stems from people who find themselves having to use or where customers are buying cash and some prefer to tap their cards instead of paying cash,
Yeah.
because in essence, the world is gradually moving away from cash. And a lot of banks are also moving away from branches that have cash inside them because we are encouraging and migrating our customers to use their apps, to use their phones, to use their laptops to do internet banking and refrain from holding cash. And yes, we understand the challenges that comes with it because, criminals tend to um, take people, uh, hold them hostage, and want them to transfer money from their apps and so forth. So some customers are not comfortable. You are still not safe if you have cash because, you are still exposed. So it's really a matter of making sure that you are able to balance the two. And your cash flow is something that you are able to prove that I, I predict that in the next 12 or 24 months, my cash flow would have increased based on the current situation of me handling this amount of cash. So your predictions must definitely be able to be proven.
Oh,
Yeah. Yeah.
okay.
So don't say I'll grow by 10% only to realize no, it's
And then and
five.
then people now realize, hey, you're not even growing by even 1%.
Yeah.
Ah,
You
I
know
think
one person. Yes.
yeah, well,
No, I was saying quickly that one person said uh, credit score is like a relationship. When you first meet a person, you need to deposit, you need to make sure that this person likes you. You need to make sure that you grow with this person. You need to make sure that after a certain period, then you move the relationship to the next level. Exactly the same way credit score works like that. You know, when you start building your score, you start small. You start with a credit of 500 or 10,000. And as you grow based on your behaviors, then you will be regarded as a lower risk type of a client who can able to repay their debt on time, who won't have any issues if you decide, I want to buy big things, I want to buy trucks for my business as an entrepreneur, then based on your credit history, and that's why it's called history, because
yeah.
it's your past behaviors, and those past behaviors are taken into consideration in how then you will be allocated or be given money from a banking perspective.
Oh, so now since you said you talked about like credit, I think this is the last one.
Mhm.
This is the last question I'm going to ask. What happens to somebody with no credit history?
The
Let's say you have
unfortunate
no.
part. So the unfortunate part is if you have no credit history, you will not be able to get preferable rates. You might find yourself going to mashonisas, loan sharks,
Loan sharks.
because loan sharks will be your last option. So I'll give you a personal story. When I started working in the bank, I wasn't working before, right?
Mm.
So from a banking perspective, for you to be able to open a check account, you should have at least a scoring of some sort. I didn't have any score. You know, the first 2, 3 years of me being a banker working at a bank, I was using a savings account. And I would envy the people who had overdraft on their accounts, who had checkbooks. I didn't have any of those things because I didn't have a score, you know. So if you don't have a score, if you don't have any credit at all, because there are people who will tell you, no, I don't want any credit, I don't want any debt. Those are the people that are at a disadvantage, especially if they want to buy uh, things in millions, you know. It's still fine. Okay.
Sorry, Jonas, somebody was calling me.
Okay.
I'm using my phone to record
Oh,
this. I
okay.
think I should
Y-
disconnect. But anyway, bad credit means bad. What's it called? Little to no existence. Now you go to a loan shark.
Yeah, so
I
if
think
you
that's
have
mhm.
no credit history, if you say you don't want debt, it means you will not be able to buy a house, you will not be able to buy a car unless you win lotto. Then you can buy them cash with the money from
So
lotto.
unless now you're operating on a cash only basis.
Yeah.
Uh, so in short, what you're saying, the whole world is operating on debt. That's what credit
Yes.
is.
Yes. Credit is something
Everybody.
that you cannot avoid. And you know, that is why we speak about your credit utilization ratio. Your credit utilization ratio means you must make sure that yes, you do have credit, but you lose less of it. You know why some people um, go to banks and say, I want a credit card. And the bank says, okay, we give you 50,000 rand limit. And then they say, no, please only give me 5,000 rand limit. And then that limit is there, you know. They know they just want to build a score.
Okay.
Yeah.
Thank you so much, Jonas. I think this first introduction meeting, there's a lot to demystify behind credit. I feel like there's a whole ocean
Yeah.
behind credit that we're going to even delve even deeper as we go
Yeah.
forward. For now, thank you so much for your time. Guys, this has been Credit Decoded by with Jonas inside the Vault edition inside the Vault episode 300 Days in Finance. And yeah, thank you so much, Jonas, for your time. I think for now we'll stop there, and then we'll continue later at a later date because I think credit is a lot. Yeah,
Yeah.
and I also
Yeah.
want like 10,000 credit limits somewhere there.
Yeah. No, definitely not.
uh,
Because exposure is also important. And thank you,
yeah,
Jung. Thank you.
yeah.
Anytime, brother. Let's touch
Thank
base
you.
and discuss further. Thank you very much.
All right.